Hello again, fellow BeachBum traders. Thank you for joining us for our video on the January effect, where we'll try to help you understand what the January effect is, how it may affect your trading, how you can be successful in trading during the month of January. So again, thank you for joining us for our video explaining the January effect. We'll go through various topics regarding the January effect. We'll look at whether January is one of the best months to buy stocks. We'll explain what is the January effect. Does January really produce excess stock returns? Again, we'll have some debate as to whether the January effect is real or not, whether it's a positive effect, is it fact or fiction, etc. And we'll explain the January effect and again how it can affect your trading. We'll give you some ideas, some strategies, how you can make money, be successful in trading during the month of January. So stick around. And we hope that you find all of this information helpful to succeed in your trading during the month of January. So let's get started.
So what is the January effect? I'll put a link to this article from Investopedia in the description box below, and we can see that the January effect is a perceived seasonal increase in stock prices during the month of January. You can see analysts generally attribute this rally to an increase of buying, which follows the drop in December when investors engage in tax loss harvesting. And we've talked about in the past couple weeks tax loss selling going on in December. Talked about the wash sale rule, and we can see that selling tends to bring prices down and spur buying in January. So another possible explanation we can see is investors using year-end cash bonuses, and we see some key takeaways. It's again a perceived seasonal tendency for stocks to rise in January. It's been pretty reliable, 29 out of 30 years. It's been an average yearly advance of 20%. It's theorized to occur when investors sell winners to take capital gains at the end of the year, and then buy weaker performers again, sell the overperformers from 1 year to buy underperformers from that year going into the next year and try to outperform the market indexes going into the next year. Again, we've talked about this for several weeks, been preparing for it. The Santa rally, preparing for the Santa rally, preparing for tax loss selling trend, and now we're talking about how can we make money from the January effect. So again, it's a perception, no guarantee, but historically we've seen an increase in January. And then you can read more detail, the explanations. Again, we've talked about tax loss selling, profit taking at the end of December, dropping prices, and people turning around. But again, they have to wait 30 days for the wash sale. So sometime in January, people may buy back those stocks that they sold off to take the tax write-off in December of that year. They'll buy back in January, and then that will cause upward pressure on those stocks. So that's what the January effect is. We can see how that plays out in a minute. Okay, if we want to see how January compares to other months of the year in terms of the returns in the stock market, we can look at this article, When's the Best Month to Buy Stocks. I'll put a link to this Investopedia article also in the description box below. And we can see that in terms of average monthly S&P gains, January on average historically returns 10%. And then we can see there tends to be a drop-off. February still positive, but much less than January. So the January effect historically returns 10%. February's down, and then we can see March, April tend to be good months as well. In details, We just talked about the January effect, beginning of the new year. We could see they're specifically pointing out that this is particularly good for small caps and value stocks. So again, that's something we've been talking about for a little while, is preparing our shopping list for the Santa rally, looking at value in particular. And again, we can see that the January effect has a tendency to be particularly good for small cap and value. So small cap value stocks would seem to be a good bet for taking advantage, making money from the January effect. So we will be looking for things in that category again to make money from the January effect. Then you could see some discussion about the January effect. We can see the Santa Claus rally, accuracy, January, first day, first week, full month, 60% of the time there was a positive return based on the Santa Claus rally and then the January effect. So again, you see a discussion that end of December is a good time to buy small caps or value, or the combination there would seem to be even better as they're poised to rise early into January. So again, this is something that we're trying to prepare for. Let's make money from the January effect, and we will see how can we do that further in a few minutes.
The January effect is a hypothesis that there is a seasonal anomaly in the financial market where securities prices increase in the month of January more than in any other month. This calendar effect would create an opportunity for investors to buy stocks for lower prices before January and sell them after their value increases. As with all calendar effects, if true, it would suggest that the market is not efficient, as market efficiency would suggest that this effect should disappear. The effect was first observed around 1942 by investment banker Sidney B. Wachtel. He noted that since 1925 small stocks had outperformed the broader market in the month of January, with most of the disparity occurring before the middle of the month, too. It has also been noted that when combined with the four-year U.S. presidential cycle, historically the largest January effect occurs in year 3 of a president's term. The most common theory explaining this phenomenon is that individual investors, who are income tax sensitive and who disproportionately hold small stocks, sell stocks for tax reasons at year-end, such as to claim a capital loss, and reinvest after the first of the year. Another cause is the payment of year-end bonuses in January. Some of this bonus money is used to purchase stocks, driving up prices. The January effect does not always materialize. For example, small stocks underperformed large stocks in 1982, 1987, 1989 and 1990. What are the best times to trade stocks? Unlike long-term investing, trading often has a short-term focus. A trader buys a stock not to hold for gradual appreciation but for a relatively quick turnaround, often within a set time period, whether that be a few days, a week, a month, or even a quarter. And of course, day trading, as the name implies, has among the shortest time frames of all. The day trader's analysis may be broken down into hours, minutes, and even seconds, and the time of day when a trade is made can be an important factor to consider. Is there a best day of the week to buy stocks? Or a best day to sell stock? Does a best time of year to buy stocks exist? How about a best month to buy stocks, or to sell them? In this article, we'll show you how to time trading decisions according to daily, weekly, and monthly trends. Key takeaways: traders often have set holding periods to time when to enter and exit their trades. Day trading, as the name implies, has the shortest time frame, with trades broken down to hours, minutes, and even seconds. The time of day when a trade is made can be an important factor to consider. The closest thing to a hard and fast rule is that the first hour and last hour of a trading day are the busiest, offering the most opportunities, while the middle of the day tends to be the calmest and most stable period of most trading days. Some traders believe that certain days offer systematically better returns than others, but over the long run, there is little evidence for such a market-wide effect. Best times of day to buy or sell stocks: first thing in the morning, market volumes and prices can go wild. The opening hours are when the market factors in all of the events and news releases since the previous closing bell, which contributes to price volatility. A skilled trader may be able to recognize the appropriate patterns and make a quick profit, but a less skilled trader could suffer serious losses as a result. So if you're a novice, you may want to avoid trading during these volatile hours, or at least within the first hour. However, for seasoned day traders, the first 15 minutes following the opening bell is prime time, usually offering some of the biggest trades of the day on the initial trends. The opening 9:30 a.m. to 10:30 a.m. Eastern Time (ET) period is often one of the best hours of the day for day trading, offering the biggest moves in the shortest amount of time. A lot of professional day traders stop trading around 11:30 a.m. because that is when volatility and volume tend to taper off. Once that happens, trades take longer and moves are smaller with less volume. If your day trading involves index futures such as S&P 500 E-minis, or an actively traded index exchange-traded fund ETF, such as the S&P 500 SPDR SPY, you can begin trading as early as 8:30 a.m. pre-market and begin tapering off around 10:30 a.m. As with stocks, trading can continue up to 11:30 a.m., but only if the market is still providing opportunities. The middle of the day tends to be the calmest and most stable period of the trading day. During this time, people are waiting for further news to be announced. Because most of the day's news releases have already been factored into stock prices, many are watching to see where the market may be heading for the remainder of the day. Because prices are relatively stable during this period, it's a good time for a beginner to place trades, as the action is slower and the returns might be more predictable. In the last hours of the trading day, volatility and volume increase again. In fact, common intraday stock market patterns show the last hour can be like the first, sharp reversals and big moves, especially in the last several minutes of trading. From 3 p.m. to 4 p.m. Eastern Time, day traders are often trying to close out their positions, or they may be attempting to join a late-day rally in the hope that the momentum will carry forward into the next trading day. There are some who believe that certain days offer systematically better returns than others, but over the long run, there is very little evidence for such a market-wide effect. Still, people believe that the first day of the workweek is best. It's called the Monday effect or the weekend effect. Anecdotally, traders say the stock market has had a tendency to drop on Mondays. Some people think this is because a significant amount of bad news is often released over the weekend. Others point to investors' gloomy mood at having to go back to work, which is especially evident during the early hours of Monday trading. For whatever reason, the Monday effect has largely disappeared. The chart below shows that while Mondays on average have marked negative returns for the S&P 500 in 2018, the effect is very small. Nevertheless, if you're planning on buying stocks, perhaps you're better off doing it on a Monday than on any other day of the week, and potentially snapping up some bargains in the process. Best day of the week to sell stocks. If Monday may be the best day of the week to buy stocks, then Friday may be the best day to sell stock, before prices dip on Monday. If you're interested in short selling, then Friday may be the best day to take a short position, if stocks are priced higher on Friday, and Monday would be the best day to cover your short. In the United States, Fridays on the eve of three-day weekends tend to be especially good. Due to generally positive feelings prior to a long holiday weekend, the stock markets tend to rise ahead of these observed holidays. Best month to buy stocks. The markets tend to have strong returns around the turn of the year, as well as during the summer months. The chart below shows the monthly average returns for the S&P 500 over the period from 1950 through 2017. There's something called the January effect. At the beginning of a new year, investors return to equity markets with a vengeance, pushing up prices, especially of small-cap and value stocks. According to Stocks for the Long Run, The Definitive Guide to Financial Market Returns and Long-Term Investment Strategies, by Jeremy J. Siegel. But again, as information about such potential anomalies makes its way through the market, the effects tend to disappear. So, in terms of seasonality, the end of December has shown to be a good time to buy small caps or value stocks, to be poised for the rise early in the next month. There's another advantage: many investors start to sell stocks en masse at year's end, especially those that have declined in value, to claim capital losses on their tax returns. So again, the last trading days of the year can offer some bargains, even if historically, a sell-off comes in December, and with it a potential drop in investment value for new investors, which is a factor to remember after a potentially big January effect. Best month to sell stocks. September is traditionally thought to be a down month. October, too, has seen record drops of 19.7% and 21.5% in 1907, 1929, and 1987. These mark the onset of the Panic of 1907, the Great Depression, and Black Monday. As a result, some traders believe that September and October are the best months to sell stocks. The September effect highlights historically weak returns during the ninth month of the year, which could be aided by institutional investors wrapping up their third-quarter positions. In fact, looking at the chart above of monthly average returns, September averages the worst among the calendar year. The October effect is also salient for some investors. Even though October, on average, has been a positive month historically, many of the worst market crashes have occurred in this month. So while September may, on average, be a weaker month than October, you may want to sell in this month to avoid the above-average volatility that October can experience. Best date of the month. There is no single day of every month that's always ideal for buying or selling. However, there is a tendency for stocks to rise at the turn of a month. This tendency is mostly related to periodic new money flows directed toward mutual funds at the beginning of every month. In addition, fund managers attempt to make their balance sheets look pretty at the end of each quarter by buying stocks that have done well during that particular quarter. Stock prices tend to fall in the middle of the month. So a trader might benefit from timing stock buys near a month's midpoint, the 10th to the 15th, for example. The best day to sell stocks would probably be within the 5 days around the turn of the month. Are there really best times to buy or sell stocks? Historically, some days or months have tended to be better or worse for stocks. These so-called market anomalies challenged theories of efficient markets. However, research shows that as these anomalies became more well-known and trading became more automated, these have largely all disappeared. Is there a way to trade stocks over the weekend? Not really. Major stock markets close on Friday afternoons and may offer extended after-hours trading until Friday evening. Saturday and Sunday, however, are often inaccessible for most traders. Is there a general rule for timing trades? The closest thing to a hard and fast rule is that the first hour and last hour of a trading day are the busiest, offering the most opportunities. But even so, many traders are profitable in the off times as well. The bottom line: these suggestions for the best time of day to trade stocks, the best day of the week to buy or sell stocks, and the best month to buy or sell stocks are generalizations, of course. Exceptions and anomalies abound, depending on news events and changing market conditions. Still, academic evidence suggests that any patterns in market timing where one is able to consistently generate abnormal returns are generally short-lived, as these opportunities are quickly arbitraged away and markets become more efficient as traders and investors increasingly learn about the patterns. What is the January effect? The January effect is the belief that the stock market has a tendency to rise in January more than any other month. While there are many potential causes, it's often said to be a result of investors re-entering the market after selling some of their stocks at year-end to lock in their losses for tax purposes. What is the January effect? The January effect is a calendar anomaly sometimes observed in the market where stock prices, especially those of small-cap companies, tend to increase slightly more, on average, during the month of January than in any other month of the year. Some traders believe that the January effect is a reliable calendar effect that can be used for trading opportunities, in other words, a chance to purchase stocks at a low price and sell them after the January effect has taken place and increased their prices. Others may simply consider the January effect when otherwise looking to buy or sell stocks around that time of the year. Why does the January effect happen? The January effect does not always happen and no one knows exactly why it does, though several potential explanations have been put forth. For example, many analysts believe it is related to tax loss harvesting before the end of the year, where investors may sell positions that have declined in order to take the capital loss in that calendar year's taxes. Those investors then repurchase the same stocks in January of the new year. The income tax theory believes that individual investors, who hold more small-cap stocks, sell stocks in December in order to claim a capital loss on their taxes. They then reinvest in the market in the new year, driving stock prices higher for the small-cap companies they are more likely to buy. Others believe the January effect is caused by people getting year-end bonuses and investing them in the market, or by end-of-year contributions to employee pension and 401k plans. It could also be caused by domestic and international investors using the new year as a reminder to invest money in their registered accounts. For example, Canadian investors are allowed to add limited additional funds every year to their tax-free savings accounts (TFSAs) and registered retirement savings plans (RRSPs). Another influence could be psychological factors. With many people reflecting on their previous year and resolving to start the new year differently, it's conjectured that they might be adopting a new investment strategy or getting more serious about investing in early January as part of a New Year's resolution. First observed by investment banker Sidney B. Wachtel in 1942, it was noted that from 1925, small-cap stocks outperformed the broader market in January, especially before mid-month. While some studies have confirmed that returns are often higher than average during January, it appears to have decreased in significance of its impact over the years, potentially because tax-sheltered investment vehicles make selling to lock in a tax loss less important as an investment and tax planning strategy. While it can still occur, it's often not significant and it's hard to predict when the January effect will be more pronounced. Tip: the January effect does not always happen, as small-cap stocks have sometimes underperformed the broader markets. This was the case in 1982, 1987, 1989, and 1990, when no January effect was seen. How frequently does the January effect occur? Historically, the January effect is observable in most years, but the fluctuations are much more subtle than they were in the middle of the 20th century when it was first observed. However, while there have been years where there were moderate declines in stocks in January, sharp declines are not common. Investors considering January effect investing should be cautious. Calendar theories like the January effect and the Santa Claus rally are just that, theories. No one truly knows why they happen when they do, and they cannot be predicted. They do not forecast market behavior, and the market can and often will defy the wisdom of these theories. They might also be costly to take advantage of, with transaction fees involved in buying and selling your positions and the time cost of researching small-cap stocks that are well-positioned to take advantage of the January effect. If the calendar theory effect doesn't take place that year, if the opposite occurs, or if the effect is not as pronounced as expected, investors could suffer losses. Tip: while the market may exhibit a statistical advantage to positive returns in January, such tendencies are measured over decades and can be subdued or not hold at all in any given year. Also, the differences between January and other months can be slight and are not appreciably different from long-term average returns in April, July, and December. Bottom line: the January effect is a calendar theory about movements in the market, but there is no way to predict if it will take place in any given year or how pronounced it will be. Investors who consider trying to take advantage of the January effect best be cautious. What is the January effect? The January effect refers to the hypothesis that, in January, stock market prices have the tendency to rise more than in any other month. This is not to be confused with the January barometer, which posits that stocks' performance in January is a leading indicator for stock performance throughout the entire year. Some analysts consider the January effect minor. Others see it as persistent, but only within certain segments of the stock market. History of the January effect: investment banker Sidney B. Wachtel first observed the January effect in 1942. Using data going back to 1925, he noted that small-cap companies tended to outperform large-cap companies in the first half of January. Numerous studies since then have attempted to detect a more pronounced January effect over time. One study that analyzed data from 1904 to 1974 found that stock returns were 5 times higher than average during the month of January. Another study by Solomon Smith Barney found an average January outperformance of 0.82% when comparing small-cap stock returns to large-cap stock returns from 1972 to 2002. A number of studies since then have confirmed some tendency for this to still occur. However, it happens primarily in the small-cap world and has appeared to decrease in magnitude over time. There's a possibility the effect may be more vigorous in any given year, but it's far from easy to predict. What causes the January effect? It's been said that tax planning is a major driver of the January effect. According to this hypothesis, investors sell off underperforming stocks in December to lock in a capital loss for the year, thereby reducing their tax bill, which causes a temporary dip in prices. In January, prices recover when buying picks up again. Another potential driver of the January effect stock market anomalies is the year-end bonus. Once they have extra cash available, investors often plow money into the markets and drive stock prices higher. There's also a possibility that investor psychology drives much of the phenomenon. Many people tend to start new things at the beginning of the year, and taking a run at the stock market might be one of them. Even just the perception of the new calendar year, believing you're starting fresh, or that you're turned over a new leaf, can have a tremendous impact on individual behavior. Still, the January effect has appeared to wane in recent decades. Fully explaining the deceleration of the effect is difficult, but there are some theories. First, the advent of more tax-sheltered retirement vehicles, such as individual retirement accounts (IRAs) and 401ks, has made trading for tax loss harvesting purposes less relevant. Also, given that many people are aware of the possibility that prices may rise in January, there is a more transparent opportunity to proactively adjust for it. How to prepare for the January effect as an investor? Because the January effect only occurs in certain contexts and appears to only have a modest impact in current markets, there are few ways to prepare. If you hold small-cap stocks in your taxable brokerage account, perhaps you could make periodic additions in December in anticipation of a possible January price increase. Should that happen, you'd have a chance to lock in some gains and rebalance to your original asset allocation. The better guidance, however, is that you shouldn't try to time the market to take advantage of perceived seasonal anomalies. You may end up with a winning set of stocks in the short run, but you may also disturb your overall asset allocation, and spend a lot of time and energy doing so. A buy and hold strategy aimed at long-term investment goals is likely going to be your best bet, so be careful when it comes to short-term calendar-based predictions. January effect: the seasonal increase in stock prices throughout the month of January. What is the January effect? The January effect is known to be a seasonal increase in stock prices throughout the month of January. The increase in demand for stocks is often preceded by a decrease in price during the month of December, often due to tax loss harvesting. An alternative reason for the rise in demand is the effect of year-end bonuses individuals receive that are invested in the market. Summary: the January effect is a tendency for increases in stock prices during the beginning of the year, particularly in the month of January. The cause behind the January effect is attributed to tax loss harvesting, consumer sentiment, year-end bonuses, raising year-end report performances, and more. The January effect appears to affect small-cap stocks more than large-cap stocks, which is apparent when comparing the historical values of the Russell 2000 with the Russell 1000. Understanding the January effect: the January effect appears to affect small-cap companies more than mid- or large-cap companies due to their lower liquidity. Some economists postulate that the January effect substantiates the fact that markets are inefficient, as efficient markets stem from the belief that higher returns are only possible by taking on higher risk stocks. Analyzing data from the beginning of the 20th century, it has been found that a variety of asset classes had outperformed the market during the month of January, which led to the belief that the January effect indeed exists. However, over time, especially in recent years, the markets have begun to adjust to the phenomenon. Furthermore, at the beginning of 2018, more individuals have begun using tax-sheltered retirement plans and have less purpose to sell at the end of the year to receive a tax loss. Additional drivers behind the January effect: beyond the hypothesis of tax loss harvesting and bonuses, it appears that the January effect may also be driven by consumer sentiment. As January is the beginning of a new year, many investors believe that the start of the year is the best time to begin investing for their future, under a clean slate. Another reason may perhaps stem from the fact that mutual fund managers hope to purchase and retain top-performing stocks within their portfolio and eliminate losers in order to heighten their year-end performance reports. Past studies and comments: based on a study that analyzed data between 1904 and 1974, the average return for stocks during January was approximately 5 times greater than any other remaining months throughout the year. In fact, Solomon Smith Barney performed an analysis behind stock performance between 1972 to 2002 and learned that small-cap stocks outperformed large-cap stocks during January. Efficient market theorists believe that modern markets are too efficient for the January effect to affect trading. That is, investors would anticipate such an effect and purchase stocks in December, as others begin to sell, which would ultimately offset the discrepancy and result in equilibrium. The January effect: in recent news for 2020, January was both a good and bad month for investing. While 10 of the 23 countries within the MSCI World Index of Global Developed Markets generated positive returns, more than half lost their money. For example, Portugal was up 6.1%, while Austria was down 5%. Essential knowledge to prepare for the January effect as an investor. It is important to understand the fundamentals of a company to be better equipped when making decisions during the January spike. It involves researching the company's financial health, such as revenues, growth potential, and profit margins, along with other aspects such as management, market position, and more. Understanding the key elements above will help comprehend price swings and movements and ultimately provide greater confidence in the stock picks that yield higher capital appreciation potential. The January no-effect historical market moves in January as far back as 1942. There is a record of people discussing the so-called January effect. The earliest expressions of this idea were related specifically to small-cap stocks outperforming large-cap stocks in the month of January. Later versions of the phenomenon were expanded to discuss the propensity for stocks in general to rise during that month. The data seems to indicate that there is attractive evidence to adopt this notion. For example, the pie charts below detail the percentage of the times that stocks in the S&P 500 Index (SPX) close higher for a given month out of all months since its inception in 1928. It does indeed appear that stocks tend to rise more frequently than they fall during January, and even more so than other months by comparison. The confounding of the January effect in 1973, Princeton economist Burton Malkiel published a popular book titled A Random Walk Down Wall Street. This book is still in print after 15 editions with more than 1.5 million copies sold. Within its pages, Malkiel lays out the case that the so-called January effect is a non-starter. What is surprising about this claim is that, at the time Malkiel first penned this observation, it was a good bit less obvious to detect than it is now. Even today, the returns from buying in January and holding until the end of the month look pretty good compared to other months if you include all the data going back to 1928. Trading the January effect. The fact remains that, for whatever reason, broad market stock indexes tend to close higher than they open more often than not during the month of January. As it turns out, there is one additional indication that can help traders sort through whether January is more or less likely to be a positive month, namely the returns of the previous month. Looking back at the past 91 years of data for the S&P 500 index, we can see that, if the index closed higher than it opened in the month of December, the month of January was twice as likely to be a positive month. By comparison, if December closes lower, January is a coin flip. This trend appears to persist even in the past 30 years. The average gain for January when December is positive is 3% for the month. However, it should be noted that the average loss for the month is 4.5%. Combining these two measures and adjusting for probability amounts to an expected return of 0. So that means traders who look to make use of this observation will have to be a good bit more strategic than merely buying and holding through January if December is positive. Hunting for market lows mid-month in January, heading into earnings season, is likely to pay off well for careful traders who manage their risk appropriately. The bottom line: the January effect appears to have some evidence to support the notion that stocks rise early in the year. However, exploiting this perceived anomaly is indeed illusory. Observing whether the previous month has had a positive return may be of help to careful traders who look to make timely entries midway through the month of January.
The January Effect, Fact or Fiction? By QI. Powering a Personal Wealth Movement. The January effect is a calendrical hypothesis that suggests stock prices tend to rise more in January than any other month. While it seems to have held some truth historically, nowadays many doubt the January effect's legitimacy. So, is this 80-year-old hypothesis a thing of the past, or is it something you should prepare for? A brief history of the January effect. The January effect was first noticed by investment banker Sidney Wachtel in 1942. During his studies of market returns dating back to 1925, he noticed that stocks tended to see greater gains in January than other months. Later, this theory was confirmed by multiple academics and spread to studies of other asset classes. As it evolved, some proposed that the January effect was the result of smaller stocks outperforming larger stocks at the start of the year. Why does the January effect occur? Analysts have offered several explanations for this effect throughout the years with varying degrees of plausibility. But most likely, the January effect occurs due to a combination of factors. Theory number 1. Taxes. One is that the January effect was the logical outcome of year-end tax loss harvesting. As investors sell losing positions for the tax benefits in November and December, downward pressure lowers market prices. Then, investors repurchase their positions in January, driving prices back up. Theory number 2. Holiday bonuses and investor psychology. Another potential explanation that aims to square this circle is that investors use year-end cash bonuses to purchase investments in January. Some analysts also suggest that January is the time for investors to follow through on their New Year's financial resolutions, leading to increased trading activity.
What is January effect? The January effect refers to the hypothesis explaining the tendency of stock prices to rise in January every year. This phenomenon occurring in January was first observed in stocks where small-cap stocks perform better than large-cap stocks. The belief in this market anomaly is backed by historical evidence, and the effect has been popular among investors for decades since its origin. However, its significance is decreasing as markets have largely adjusted for its occurrence and investment strategies based on this seasonal anomaly are no longer rewarding or highly profitable. Key takeaways: the January effect refers to the theory explaining the tendency of stock prices to rise in January every year after experiencing a price drop in December. The investment banker, Sidney B. Wachtel, interpreted the effect in 1942 based on his observation of small stocks outperforming the broader market in January 1925. The common reasons behind the effect are tax law harvesting, window dressing, investment using year-end bonuses, and psychological factors. Examples include the effect that happened and reflected in several indexes in the United States in 2019 and 2020. January effect on stock market explained. The January effect theory states that the stock and other assets price in the financial market rises in the first month of every year, specifically after experiencing a price drop in the last month of the previous year. It was first introduced in 1942 by the investment banker Sidney B. Wachtel, famous for his journal article, Certain Observations on Seasonal Movements in Stock Prices. From 1925 he noticed the small stocks outperforming the broader market in January. Furthermore, studies also revealed that the effect became smaller during the last 2 decades of the 20th century. There are different reasons behind this market anomaly. Firstly, investors engaging in tax loss harvesting can contribute to the effect. Tax loss harvesting is the phenomenon of investors selling losing positions before the end of the financial year to obtain the tax benefits and repurchase them in January. This selling lowers the market price, and repurchases in January escalate the prices. Other factors include the investment of year-end bonuses in January, psychological factors motivating investors to invest at the start of a new year, etc. Another reason to point out is the window dressing technique used by portfolio managers. Portfolio managers apply this technique before reporting the details of the holdings to the investors at the year-end. By December, they remove worst-performing stocks from the portfolio to make it satisfactory. However, they can add it again to the portfolio in January and expect a reverse in the trend exhibited by the poor performers. These acts can contribute to specific securities price drops in December and price rises in January. Several examples point to the uniqueness of January exhibiting higher returns and volatile nature. In many countries, December is the end of the tax year, so it hosts many significant events associated with stock trading and indirectly contributes to the stock price rise in January. Even though the effect is not guaranteed, investors can design strategies based on it by collecting small-cap stocks in December, specifically small-cap stocks with poor performance, and completing the trade or transaction in January. Let's look into the effect that happened in 2019 and 2021. January effect 2019 stocks of General Electric, Mohawk, Newfield, Affiliated Managers, Coty, Xerox, Invesco, Western Digital, L Brands, Alcoa, Unum, Brighthouse Financial, and IPG Photonics underperformed the broad market in the first 3 weeks of December 2018, given they have not shown unattractive fundamentals, indicating that the sales and price drops are not fundamentally driven. However, most of these started recovering by the end of December 2018, beating the S&P 500. It is followed by increased investor buying enthusiasm in January 2019, driving the price of last year's underperformers upward. January effect 2021. At the beginning of 2021, the January effect swamped the market. Traders and investors have the tremendous feeling that all marketplaces and commercial centers will open in the coming months. The proofs pointing to the swamp are the following. The S&P 500 climbed 2.4%. Small stocks, indicated by the Russell 200 index, surged in January 2021. Oil and gas stocks are recovering after a setback in 2020. Gannett Co. GCI shares dropped 47% in 2020, has recovered 25% in 2021. Examples of other January effect stocks in 2021 include Occidental Petroleum, which was down 55% in 2020, gained 24% in 2021, and Continental Resources, which fell 52% in 2020 and recovered 17% during 2021. What is the January effect? The January effect, also nicknamed the January barometer, is a calendar effect specifically in relation to the stock market's anomaly experienced in the month of January, which is characterized by an increase in stock prices. A market anomaly refers to the distortion in stock prices from the expected performance, as set out by the efficient market hypothesis (EMH). Whereas, a calendar effect, on the other hand, refers to a market anomaly that is related to a specific day, month or any time of the year and with a frequent tendency. It should be noted that the month of January generally tends to be a good season for the markets overall. However, the January calendar effect as a hypothesis would prove that the financial markets as a whole are inefficient and therefore the month does not offer investors with any right arbitrage opportunities. According to Burton Malkiel, an ex-director of Vanguard Group, and the author of A Random Walk Down Wall Street, he states that the January effect doesn't last long. Also, even if it was to be exploited by buying stocks in large quantities to sell or the opposite, the transaction cost involved dips into the profits that were to be realized. How does the January effect work? The January effect was first noticed by renowned investment banker Sidney B. Wachtel at around 1942. In his observation, he noted that small stocks kept outperforming the large stocks, with most of this unexpected performance occurring before the middle of January. From Wachtel research, he noticed a consistent pattern since the year 1925. Wachtel's observation was supported by a study that analyzed the market's data for over 70 years running from 1904 to 1974. The study discovered that the return on stocks was 5 times greater, especially with small capitalization stocks, during January than in any other month. Further, to support the existence of the January effect, a different study analyzing data from 1972 to 2002 conducted by investment firm Solomon Smith Barney found out that some stocks outperformed by 0.82% during January but underperformed throughout the entire year. The investment firm research discovered small-cap stocks, as measured by the Russell 2000 index, outperforms large-cap stocks, Russell 1000 index, possibly due to the January effect. However, this market phenomenon in recent years it has proven far more difficult to profit from, as it seems the market has adjusted to it and therefore it is less pronounced. The January effect is a hypothesis and does not always materialize as expected. For instance, research data shows that small caps underperformed large caps in January of 1982, 1987, 1989 as well as in 1990. As from the year 2016, market analysts have considered the January effect as less significant to market performance for reasons such as, people no longer need to sell stocks for a tax loss due to the availability of tax-sheltered plans such as 401ks and IRAs. With the market anomaly having been in existence for long, so many investors anticipate the mid-January effect, and so the markets have over time adjusted to it with no reliable opportunities to exploit. Nevertheless, the adjustment has, in turn, created another market anomaly in December called the Santa Claus Rally, where many investors buy stocks that are low-priced in order to try and take advantage of the January effect by selling at increased prices. Whereas both the Santa Claus Rally and the January effects are trends worth monitoring, anyways, it should be noted that market analysts generally agree that they are not a reliable way for investors to reap easy short-term earnings. Possible explanation for the January effect. Various market factors have been presented as the likely reason for the stock gain experienced in January by small listed firms. Researchers from AQR Capital have established that small stocks have generally outperformed large ones by an average of 2.1% in January from 1926 to recently in 2017. The reason for this market rally includes investor psychology. Many individual investors follow up on New Year's resolutions starting from January, and the momentum and energy associated with the need to start investing for the future rallies a peak in the stock market. Window dressing. This is when an institutional investor such as a mutual hedge fund managers go shopping at the end of the year for stocks that have outperformed in order to deceive individual investors that they have a successful portfolio while in essence, they made losses. Tax loss harvesting. Traders or individual investors frequently dump stocks at the end of the year so that they can claim capital losses. These massive year-end sell-off drives prices down. Consequently, it also attracts investors interested in the low rates, and as a result, driving prices back up in January. Repurchases. Those engaged in tax loss harvesting in December make stock repurchases in January, and also investors use year-end cash bonuses usually paid in January to invest in the market, therefore, causing the January effect. Benefits of the January effect. Despite the view that the market rally provides minimal profitability, due to its short period and substantial transaction cost that literally eliminates profitability in buying and selling or the other way round. However, if you look at January on a market cap weighted basis, the effect is still more pronounced. Possible benefits that can accrue to stock investors include, predictable seasonal fluctuation that typically spans December and January, enables stock traders to account for certain price variations and take advantage of market volatility in determining the possible entry and exit points and expected profitability. Presents an opportunity to make the most of the year-end losses which can later be declared as a loss on an investor's next tax return. An opportunity to reinvest money from year-end tax selling in December, but in hopefully more profitable stocks. Presents an opportunity for investors to take advantage of the year-end bonuses to invest in small-cap stocks in January immediately they are in receipt of the fund. There are other seasonal market anomalies too, such as the July effect and many others. However, the way the January effect helps small stocks and hinders large ones in terms of price run-up is particularly interesting. Nevertheless, if you are a momentum investor, then January may prove to be a challenging month with little stock arbitrage. Momentum investment is buying stocks that have had a price rally over the years but in a consistent manner. These portfolios of stocks tend to continue to perform, that is, consistently gain momentum in performance. In contrast, the January effect doesn't last and guarantees no momentum. Still, investors looking to add small companies to their portfolio should consider doing so in late December in order to maximize on the January effect's possible benefits. Besides, small stocks are less expensive and more profitable in the long run as they tend to outperform over time according to research. Of course, they don't deliver consistently. It should be understood that the markets are inefficient, but over time, research suggests they can improve investment performance. So, how does an investor effectively take advantage of the January effect? Below are some suggestions. Select small firms, small cap stocks. The January effect is more pronounced with small cap stocks, possibly because they are less liquid. Therefore, an investor should identify a small company as an investment vehicle. Have a risk strategy, develop a good plan and if possible get a trading journal and track the approach that works for a robust trading plan which will mitigate risks involved. Know when to buy and sell. Investor should perform due diligence before executing a trade, by considering factors such as a stock's past performance in recent days, weeks, months and prior years and backing it up with reliable research. This will ensure that the entry and exit point in a trade provide enough profit margins. Stay up to date. Be informed of the happenings around the stock markets. Having an RSS feed is ideal as an investor will have vast and reliable news sources delivered fast to guide one in investment decisions. Focus on either short or long positions. There are available opportunities in either direction depending on your timing and the size of the stock. However, an investor should not often switch between the two. If you typically focus on short positions, then stick with in order to reap maximum possible benefits. Get professional advisory. If as an investor you are totally green to the stock markets, it should be noted that the markets are highly volatile with a potential risk of losing all the funds invested. The most appropriate call is to get a professional to do all the hard work for you at a fee. In conclusion, debates will always be there as to whether the January effect holds any ground as an opportunity to exploit the market or it's just a market rally with nothing special about it. Either way, investors should strive to make informed choices because the markets, as stated earlier, are not efficient enough to guarantee consistency.
Thank you for watching our video on the January effect to the end. We hope that this video has helped you understand what the January effect is, whether it's real or not, whether it's fact or fiction, whether you can get an edge trading the month of January, and also hopefully we've given you some ideas as to how you can be successful in trading during the month of January. Please let us know in the comments below, in our free Discord, in our free Facebook group, all of which you can find links to in the description box below, as well as via our social media sites. Let us know what you think. Do you think the January effect is real, fact, or fiction? Do you think there's an edge in trading? Is January one of the best months to trade stocks? Again, let us know in the comments, in our free Discord, in our Facebook group, via social media, etc. And let us know if you have any further questions, any other ways that we can help you be successful in trading during the month of January and or throughout the rest of your trading year. So thank you again for watching our video to the end. Good luck and have a great trading January and a great trading year. The content of this video was produced by BeachBum Trading. We hope you will choose to also join us in the BeachBum Trading community and subscribe to our YouTube channel. Visit us at our homepage at beachbumtrading.com, the bum without the U. Similarly on Twitter, BeachBum Trading, bum without the U. On Facebook and in our BeachBum Trading Facebook group. Please follow us on Pinterest and on Instagram. All of the links to our social media sites will be included in the description box below, and we hope you will choose to subscribe to our BeachBum Trading YouTube channel and follow us on social media. Thank you. We also cordially want to invite you to our new BeachBum Trading Community Discord server, where we can have discussions on all topics related to trading, success in trading, investing, etc. You can see alerts when we make trades, changes to our watch lists, etc. So again, please join us in the new BeachBum Trading Community Discord server. You should be able to find a link in the description box below. You can also find a link in the social media category on our webpage, beachbumtrading.com, without the bum without the U, and also in the link section on the About page of our YouTube channel, etc. So again, we look forward to seeing you in the BeachBum Trading Community Discord server soon. Wave and say hello. Another way that you can help support BeachBum Trading and being able to produce frequent quality content for you for free on YouTube, etc., is in addition to subscribing to our BeachBum Trading channel, hitting the like button on our videos, and hitting the notify so you're alerted when we release further videos. You can also choose to show your support for BeachBum Trading with a super thanks, which you can find below this video. If you hit the heart with the $sign, the super thanks, again, you can financially support BeachBum Trading in whatever amount that you wish, and we greatly appreciate your support, and that will help us, again, be able to produce frequent quality content that we can provide for you and all your fellow BeachBum traders around the world for free on YouTube. So again, we greatly appreciate all of your support, and thank you very much. Thank you again for watching our video. We hope that you liked it. If so, please smash the like button, give us a thumbs up. If you're not already subscribed, please consider subscribing to our BeachBum Trading YouTube channel. Please share this video with your fellow traders and friends. And please give us your feedback and any recommendations for improvement in the comments section below. And let us know what else we can do to help you in your trading career. Thank you again, good luck, and have a great trading day. If you like this video, we hope you will choose to subscribe to our YouTube channel by clicking on the box in the upper left-hand corner. You can watch another video like this by clicking on the box in the lower right-hand corner. And we have a whole playlist of videos like this that you can access via the box in the upper right-hand corner. Our latest video is available in the box in the lower left-hand corner. We hope you like this and have a great day.